Welcome back to the Brent Bruce Daily. Today is January the 31st, 2024. It's 3:57 p.m. Central Time, and we have now heard from Jerome Powell, chairman of the Federal Reserve Board, as to what the Federal Reserve has decided to do with the federal funds rate for this round. And we also received a report from ADP on the payroll report that was actually for the month of December. So we're going to take a look here and see how that's affecting home loan interest rates, because these are key reports in what to expect for the future. So first off, let's go over and take a look and see where we are. I guess we'll start here. The Federal Reserve, Fed Chairman Jerome Powell, I almost said Ben Bernanke. I had a little flashback there. Jerome Powell did come out and announce that the Federal Reserve is not going to increase or decrease the federal funds rate this round. They're leaving it the same. But here is what markets are really reacting to is we kind of knew they weren't going to do anything with the federal funds rate this time. But there were people that were hoping that they were going to hint, that Jerome Powell was going to hint that they would begin to contemplate making a change of reduction in the federal funds rate the next time they meet, which is in March. Now, there's a couple of things that you pull out of this report. First of all, they are not talking at all. Nothing that I'm seeing is the Federal Reserve talking at all about, are they going to increase rates again? And that's all we used to hear about. All we wanted a few months ago was to hear them say that they want to leave rates alone. We're beginning to think about stabilizing the federal funds rate. So we went from the increasing flow to hoping they were going to stabilize it, which they now have. And now the talks are about interest rate reductions on the federal funds rate. So we have really turned the opinion of the Federal Reserve. Now, they did say that they don't think that they're going to reduce the federal funds rate on the March meeting. They think that might be too soon, and they don't want to let the Fed funds rate come down too soon because they feel that inflation will rear its head again. So they're going to try to make sure that this fire is all the way stamped out. Now, our concern has always been, will they go too far? So are they going to take a fire hose instead of a garden hose to our economy? We hope that they don't entirely demolish it and flood it instead of just using the proper amount of water, for instance, to get that under control. Now, we do seem to think that they're going to reduce the federal funds rate in the next meeting, which would be May, if it's not in March. So if things continue on the path that we are on, we should see the federal funds rate come down in May, and there is still a possibility that happens in March, depending on what happens on Friday of this week, which is the big BLS employment numbers that are going to come out, which I talked about yesterday or the day before, that is the report of 2023 that absolutely changed the trajectory of interest rates through the entire year of 2023. That pivoted. That happened February, I think, 2nd of 2023, or maybe it was the 3rd. This year, it's going to be February the 2nd, this Friday, that we're going to hear from the Bureau of Labor Statistics to tell us how they feel about the employment numbers of the month of December. That's going to be a big report. So two things. We did hear the Federal Reserve come out and say the federal funds rate is going to remain the same. And we also are looking for the BLS report that's going to come out this Friday. So let's take a quick look here and see what's going on with home loan interest rates with that information. Jumping over to our charts for a moment here, supplied to us by MBS Highway. So after this day, we are up 28 basis points. Now, one other thing that I want to point out is that there's the Bureau of Labor Statistics employment report that comes out on the first Friday of every month. But just before that, 2 days earlier than that, we get a report from ADP, Automated Data Processing, which is the largest payroll provider in the United States. Those are people that probably have a pretty good hold on what's going on with employment, ADP. Well, they come out and they say that the employment numbers are considerably lower than what the expectation was. So that means that if employment is not as strong as they had anticipated that it was going to be, and if that rolls over to the BLS report on Friday, home loan interest rates should improve because of that. Now, here's what I want to point out. This is the key here. I just mentioned to you that last year, the February 3rd report that came out really changed the trajectory, unfortunately, in the wrong direction from us. And we went from about 6% to about 8.5% throughout the year. Okay, so that kind of effect that this report can have. Now that again, that the report for this year is coming out in a couple of days. And this is what we learned about the report that came out last year that we didn't really understand at the time. First of all, this report now includes, they've changed things. My understanding, what I've been told, is that this report now tries to include people that are making cash under the table and consider them employed. Okay, so they're trying to kind of get an idea, well, we think that X number of either undocumented workers or people who just get paid cash, how do we assess that if they're not on the payrolls? And they go in and they try to make an estimation. So that was something that we didn't used to see happen as often, and that was a tremendous change to this report. Matter of fact, we were expecting a loss of about 300,000 jobs in January of last year when the report came out. We ended up having a gain of 500,000 jobs. So an 800,000 variance. And a lot of it was because of them coming in and saying, well, but we figure there's probably, another 800,000 people that are getting paid under the table. Now, that's fine if the way that we've always done it, but it wasn't. So all of a sudden, the estimates of negative 300,000 were blown out of the water. Now, if we had always done it that way, the estimates would have been the same and employment rates would have remained traditionally the same, substantially the same. But it's not going to happen when you change the report. And that's what happened. And on top of that, little known to many, they came back during the year of 2023 and revised that report. They revised the employment numbers down 500,000. Okay, so they oopsied and overcounted the employment numbers by 500,000. And here's the thing. The headline reading is what the market is going to always respond to. That is the big, neon sign, the headline reading. If 2 months later, there's a one-liner on CNBC that says, oh, by the way, turns out it was a little bit less than that, 500,000 people, no one pays attention to it. So the impact of the headline has already gone in and affected the markets. And unfortunately, the adjustments or the revisions after the fact, they just have nowhere near the impact as the original headline number. So over the last year, we've realized that employment wasn't as strong as they were projecting, but unfortunately, the damage has already been done. But let's look at it. Since these numbers have come out and they have actually kind of the cat's out of the bag, we were talking about 8.5% on a 30-year fix on the Brent Bruce Daily, or 8.25. And let's take a look and see where we are today. Now that, as we say, as the cat's out of the bag, and we've done a revision to employment numbers, and things have definitely improved with the inflation readings as well. Let's go over here and look at the Brent Bruce Daily. Okay, so our scenario here, very well qualified 30-year fixed conventional home loan. This is pulling up. And again, I think we were like 6.625, somewhere in that range yesterday with no points. Now we've heard from the Federal Reserve. We received the ADP report on employment numbers. Guys, we're sitting at 6.5%. This is again with PRMG. That's the wholesale bank that we can get that through. And with a credit of $1,051. A credit. Okay, so that shows improvement. United Wholesale coming back. There they are in a position of pretty strong position there as well. Let's open up this PRMG and see what other interest rates we have to work with. What if we were to pay a point? We are at 6.0. We are getting so close to 5.999 with a point, guys. We are almost there. And I'll tell you what, if this report comes out positive for us on Friday, the BLS report, we're going to be in really good shape. Probably not just this month, but you can probably be pretty confident we're going to be in good shape for the rest of 2024 and maybe a few years after that. All right. So we can talk on another report here about the experiences of the Great Recession of 2007, 8, 9, 10, 11. Like I was doing the same thing all through that time. We could talk about how that turned out. So let's take a look here at our parameters to the loan that I am making giving our estimate on right here. And if you have any questions or need anything else, please make sure to reach out to me and make sure that your customers, your buyers are calling or emailing or DMing or texting or anything me so I can tell them what the numbers look like for their scenario. Because let me tell you, your customer might buy that house when they get a 6.5% interest rate. and they may be getting quoted by their current lender 7.25, 7.375. Make sure that you always get a quote from me as well. Let me know if you need anything. I'll get back with you again soon. Talk to you then.